Hi everyone, and welcome to this afternoon's webinar. I was just waiting for the little red button to come up on my GTW icon to confirm that this session is being recorded, so we can start. But before we do, as always, may I draw your attention to the disclaimer that I believe is on your screen. As you know, trading can be a very risky business, so please don't even think of using money that you cannot afford to lose. It's good to have you join us. As I said, I see on the list of attendees, we've got some people who were with us in our earlier session when we were looking at the Forex market. We've got some of our quantum customers, we've got some education students as well, and I think people I've not come across before, but whoever you are, wherever you are in the world, it's lovely to have you with us, and let's see if we can make this as an interesting and informative session as possible. Can't promise the fireworks we had last Friday, which was great, wasn't it, David? Fantastic. Red is David's favourite colour. Brilliant. It was absolutely fantastic. So moving the session last week from Thursday to Friday turned out to be a good decision, actually. Right, here am I. There's me. There's David, and we will be looking at the markets through the prism of volume price analysis, but we will also be looking at how all the capital markets interrelate with each other. What is what is maybe happening in one market? How is that going to be impacting something else? Because they are all connected. As traders, it doesn't matter whether you trade a single instrument, an index, a gold or oil, or you're a Forex trader. You have to be aware of the relationships that exist between these markets. When we first started, no one really talked about intermarket relationships and analysis, cross-market analysis, as we called it. Everyone's, was in their little silo, as it were, and that was it. They were kind of vaguely aware of what was going on in, if you're a bond trader in equities. And we can actually prove that, because when we used to live back near London, one of our traders, well, a couple of very famous traders next to us, actually. One of them was a guy who's mentioned in one of my favorite books. It's called The Secret Club That Rules the World. It's about a big oil trader and runs an oil hedge fund. And it was amusing to read that one of the people mentioned in there, as I said, lived very close by to us. And we were, looking at oil and what have you. But we also stumbled across one of our neighbours who had been a bond trader, a very big bond trader. He just sort of retired. He could afford to retire at the age of, what was Brian, was it 26, 27, 28, something like that. He'd made a lot of money. And we said, oh, bonds, great, you must know about this. But he knew nothing. He knew nothing about the other capital markets. He was in his little bond silo, and that's what he was, and that was what he was focused on. Those days have gone. You have to be aware of what's going on in all the capital markets, and to try and get a picture, a landscape of what is the sentiment in the market. Where is the money flowing to? What is it flowing out of, and what is it flowing to, and where do you sit in this landscape? So today we're going to be having a look at the indices. I'll just take this down, move it over. And because we're going to be having a look at the indices, what is the market that is going to give us some idea of, whether indices are likely to be going up? Are they going to be going down? And this is where the bond market comes in, and you'll be reading about it yourself. The 10-year yield is the kind of benchmark that everyone uses to get an idea of what is market sentiment. Where is the money flow? When money flows into bonds and yields go down, generally it is not good news. I know money is cheap because the bond market is the cost sets the parameters for the cost of money. Now we've got here the 10-year bond. If you haven't got it on your platform, investing.com, it's a great free site. You can look up all sorts of instruments and markets. This is the 10-year bond. It's actually come back a little bit. It's gone up slightly. This is on the daily chart, and we have seen a little tick up of a positive sentiment for the indices. We've got the S&P futures. It's kind of flip-flopping around a bit. The VIX back over 15, which is not too clever. because if markets are going to carry on higher and certainly recover from that swoon that they had on Friday, then the VIX has got to go down. Anyway, the best way to explain this is to have a look at the charts. I'm actually going to also be talking about the pound yen chart for a number of different reasons. First of all, because it's got the yen in the pair, and the yen is one of those barometers, if you like. Currency it's a barometer of risk as well, along with the VIX and the bond yield. But there's some really interesting price action, VPA price action, volatility on this chart. It just happens to be the pound yen, but it really applies. It can apply to any instrument, and any market really. But before I do, let me just pass over to David, and as I said, and then we'll come back and have a look at the pound yen, and then we'll move over to David because he's got the indices, and on Ninja 8, they look prettier on Ninja 8.
I thought you'd forgotten about me.
Oh, no. I'll have my tea.
I'm just having a tea. We're having a cup of tea here. Very warm welcome. Good to have you with us today. And as Anna said, lots of new names on the attendees. So good to have you join us. And welcome to all of you who come along regularly. So good to have you. If you have any questions very quickly, then we're happy to answer them in the chat box if they're short ones. But if they're longer questions, then we will answer them on air for you. The two platforms we focus on primarily here, NinjaTrader 7, Anna's on NinjaTrader 7, and I'm on NinjaTrader 8. I've actually got TradingView running as well in the background, so I might pull that up if, depending on how the price action goes. It's a little bit sluggish at the moment, and it's certainly not like it was last Friday, which was an absolute blinding day, and just a day to make money, which is what I said at the time. And it actually reflects precisely the point I made, that when you get those big move days, that is the day you've got to make money. You have to make money when the market is moving with strength, momentum. It's clearly going in one direction. It's not stopping. You've got to get in there and fill your boots up, I'm afraid, because they are not the norm. The norm of the days we're having today, which is pretty much sideways and pretty much what we've seen all week. Much, much tougher trading in these conditions. Anyway, let me pass you back to Anna and we will get going.
So have to factor in today. Well, it's a number of things. First of all, I think there's very little fundamental news that's of any significance for the rest of the trading session. I think there's a lot of Fed people speaking, some voting members, some non-voting members. It's also end of month and also end of quarter, which has its own characteristics. Sometimes you get a lot of dollar buying at the end of the month, and because it's the end of the first quarter, there'll be a lot of reports that have to be written to investors, and a lot of what's called squaring of position. And also, everyone will be looking back to this first quarter just to see, well, this is what's happened in the first quarter, which was a recovery, has been a recovery from what happened just before Christmas, when we didn't have Santa's rally. So there's all these other factors to take into account today. And what David is also going to, as I said, because they look pretty on Ninja 8, is having a look at the monthly charts, which are really interesting, because once this week is finished, this quarter has finished, this month has finished, this market, everybody looks to next quarter. What is going to happen? We're still nowhere any resolution on Brexit. No, the tariff with the US and China. So there's a lot of things sort of blowing in the wind that really haven't been nailed down. But I just want to highlight a couple of things from a VPA perspective, multiple time frame perspective, and indicator perspective. This was the 3-minute chart for the pound yen, and it was where am I? Oh, I've missed it. It's the 3-minute chart. Here we are, and it was way over here back at 11:30 this morning. There was a really nice move developed on the pound yen. There was selling of the pound on, I think, on some kind of Brexit news, but whatever. Very nice, it looked like a very nice waterfall, widespread and increasing volume. And you look at that and you think, if this is using one chart, one time frame. And I use the 3-minute chart a lot, both on MT5 and on Ninja. It's just a time frame. I find it, you know, it's not, the 1 minute is a little bit too noisy, and 5 minutes is a bit too slow. Sounds silly, but you know, that's the way it is. And that came in, and then, you know, you look at that and you think, well, hold on a second. Under classic VPA, you've got falling market, you know, widening spreads, rising volume. Well, you know, what's not to like about that? And this is where, and as I said earlier, I've had emails about this before from traders who send me a screenshot of one chart, you know, a typical candle combination, and say, well, you know, what do you make of that? As if, you know, what's up? What is it? A problem with VPA or what have you? And it's not. What it is everything has to be seen in the context of multiple time frames. Now, the multiple time frames I have here generally is, I've got the 3 minute, I have a few more, but I then go out and have like a benchmark, and it's either the 30 or the hour. And this is the candle that was forming at the time of that that waterfall that was setting up on the 3-minute chart. And the thing to note is these little purple triangles. This is the volatility indicator that we have developed, and which basically triggers in real time, and it tells you that the move on this chart is outside of the average true range for this particular instrument. What happens then is, when this is triggered, it will then retreat to within of the spread of the candle. That's the first thing we know. So basically, down on the 3 minute, we saw here, which was this really nice, setup from the break. It was really a breakaway trade from the volume point of control, and you think, great, you're in there, you've got you know, rising volume, nice spread of candles, and then suddenly it looks like it sort of comes to but it doesn't come to a stop in the classic VPA way. And if you were in that trade, not using volume price, not using multiple time frames, it would truly, I believe, it would you know, confuse you. And the reason was simply because on a slower time frame, you had the trigger of the volatility. But what is interesting, although it's now back on the move, it did actually reverse. We actually had a 2-bar reversal here. Then we had a move higher, a very scrappy move higher, I have to say. Not you know, not really very noisy, very, I wouldn't say volatile, but I call a scrappy move higher. Then you had a pullback. Then you had this trigger of the volatility on the 3-minute chart. You have to remember, this is a 3-minute chart. And again, the first thing that happened, you have the retreat to within the spread of the candle. So you now, on the volatility candle, have a high and a low. But what's interesting is, on the 3-minute chart, is look at the time that this has actually been. This is a 3-minute chart, remember, between the high and the low. And in the previous session, what we talked about was this particular setup on these two charts, and what you have to do as a trader when you see this happen. And you know, you say volatility has been triggered. We then always say you have to wait. It either breaks to the top or the bottom. But look at the time that it has taken. It's been on this sort of support platform here, just below the candle here, 144, 144.80, 70, 79, something like that. Now we are seeing a breakdown from the volatility, but first of all, note the time that it's been within this candle. And then if you go up to the 30-minute, what we also said was that is also still trading within the spread of this volatility candle. What that will tell you, if this move does carry on higher, where do you think it's likely to go? It's likely to go down to and test the low of the volatility candle. We talk about volatility, we talk about the volatility indicator a lot, and what is likely than not to happen once it's been triggered. But you can also use it to actually have an idea of where the price action is going to go before it breaks either to the top or the bottom. I said, we're not here to talk about Forex. It was really just to bring together, you know, multiple time frames, what happens when you have volatility, but also to take into account, as I said, this is a 3-minute chart, but look how long it's been in essentially a congestion. Within that congestion, there have been, moves up and down, but very much contained within the spread of that candle. Now, some very fast scalping traders, if you're on the second chart or you're using renko or ticks, would say, well, that's a move. I could have taken some points either up or down. That is true. That is up to you. That depends on how confident you feel trading within that, in that kind of environment. All the indicators would be suggesting that the risk on any trade of that type would be much higher than if you had a clean breakaway or a definitive reversal. The indicators were highlighting that. And also on the renko, this is how it would be represented. Very, very choppy. Taking trades when markets are choppy they are going to be much, much higher risk. Traders still take them, but it is a much, much higher risk. But if you don't understand that you are in a choppy market to start with, and why you're in a choppy market, you are really going to make life very, very difficult for yourself. And as I said, against all this, you still have to be aware of what is happening on the fundamental other related markets. What are the other signals coming from these other markets? What are they actually telling you, maybe to give you some confidence or not, in the direction of whatever you're trading? David, is there anything else you want to say to that, or can I move back over to you now?
Yep.
Okay, do you want to come over to you?
Yeah, can do. Just switching screens onto the Ninja 8. There we go, just move the chat out of the way. I've gone to the YM on this occasion. So mixing it up a bit. Normally have one of generally the ES or the NQ, but let's go back to the YM. It's a little more even paced. Certainly not quite so volatile as the ES. At any rate, and what I've got here, I'm on the time-based workspace. I've got 3, 5, and 10 minute across the top. Down the bottom, I've got 30. I've got the renko in the middle, and I've actually got this over on the monthly for the index. And before we started the webinar, I said to Anna, it was about 3 o'clock. I said, this has got a bearish feel to it. It's the market's tried to rally. This is nothing like the price action that we saw last Friday, which was relentless to the downside. It was just a question of where you actually got in. You can see the momentum in this move is not dramatic. It's moving a few candles lower, then it's having a little rally, and then it'll probably move a few candles lower further. But around 3 o'clock-ish, I think the trend monitor was sort of this sort of length. The red, it had transitioned to red, but it was very minor, and I don't think the 10 minute had actually transitioned at that point. So what we're seeing now is just confirmation of this, I'm going to call it a minor bearish trend, because it's not strong, it hasn't got momentum. That's not to say there aren't points to be taken. I mean, when you look at the chart, let's put it back up full size. Anyway, you got in this price waterfall, this mini price waterfall, which was confirmed. As you can see here, we've got rising volume and falling price action, which is always a good thing to see if we're short. It's what I look for all the time, because it just gives me the confidence to get into trade. But I mean, we're talking between this range here, down to the bottom of here and up to the top of this, that is 60 points. Now, even if you took 10 or 15 or 20 out of the middle bit, that's still not a bad return. 20 points at $5 a point on this contract, $100. It's worth having. It's not bad for a few minutes work. Just see where we're going at the moment, and down onto the 30. There we go. The nice thing with Ninja is that it really does align with your local time scale, so you can tell precisely where you are at any one time. It's 3:30 UK time here. The US markets have been running for 2 hours now. Normally it would be an hour, but we go to British summertime on Saturday night, so we will be back to the usual for us, which will be an open at 2:30, whereas this week, or certainly for the last few weeks, it's been a 1:30 open. The current trading range on the 30, we're very tight. We're on the volume point of control, this yellow dashed line. That is the fulcrum of the market. It's where price agreement's been reached. It's where the heaviest concentration of volume is. And we are still trading around that region. in terms of using a multiple time frame approach, this is where it really comes to the fore. So the upside maybe not quite so important at the moment. We've got some various layered levels of resistance. These dash lines, these blue dash lines and red dash lines, denote price-based resistance or price-based support. The wider those lines, then the stronger that level is, because what the indicator does, it's accumulation distribution. It's looking at the number of times that level has been tested either from above or below, and the greater the number of times it's been tested, and the numbers are actually printed down the side here, you probably can't see them. They're underneath the VPOC actually, but the wider that line, then the greater the number of times that particular level has been tested. So what we're seeing now, if we're trading short and we've got a 30-minute time chart and we're a scalping trader, we can see we've got a very strong level of potential price support. It may not act as support, but it certainly has the potential to, given its strength, at where are we, 590, let's say, 10 points below the 600. So if we're going to trade short and we're going to take a scalping position, we've got to be aware of the fact that we've got this here. Now, if it gets through that level, good news is we've got low volume in terms of anything that's likely to cause a barrier to a deeper move, and there's nothing in the way of price. So if the market does manage to penetrate this, then we expect there is the possibility for jumping in maybe around the 25,580 region, and you've got a further 20, 30, 40 points, maybe even more before we get down to this sort of level. The question, of course, is whether it does break that level, and if it does, at what point you are comfortable getting into the trade. The other aspect to it is, if you're looking at a short position here, be aware of what is likely to happen here. We expect the market to congest, and when you're trading on a 5-minute chart and the market moves into congestion, if you look at the slower time frames, they'll often give you the answer to that question: why has the market done that? Why has the market paused? It is the major single reason to trade multiple time frames, not only from a charting perspective, but also from an indicator perspective. You can see the trend monitor, it's bright red. It's bright red on 5, it's bright red on 10. It hasn't transitioned yet on 30. You wouldn't expect it to, because you haven't got enough bars to tell the indicator that we are now looking at a significant change in trend that is cascading down the time frames from 1 minute or even 30 seconds if you're running that fast to the market, right the way through. We're now cascading through down into 10-minute. It would probably have transitioned on 15, but it hasn't yet reached 30. And the analogy is always that of dropping a pebble in the pond. You drop a pebble in, and the ripples from that landing of the pebble in the water then flow away from it. And that is exactly the same as happens in the markets across multiple time frames. Now, the other important, obviously, moving to the currencies, is to consider the yen. In fact, I've got it here. This is on TradingView. It's just, I had it set up this morning or earlier on. It was just an easy, quick way for me to show you multiple time frames. What we've got here is 10-minute, the 20-minute, and the 30-minute. And the currency we're interested in is this one. It's the magenta, the Japanese yen. You can see it. So we've got pretty strong buying on 10. We've also got strong buying on 20. We had quite a lot of selling this morning, but that's now reversed. It's often the case. Once you've moved through a session, we're into the US sessions, and now we're starting to see that buying trickle through into the 30-minute as well. So for the time being, we are seeing strong yen buying, which is going to be reflected in terms of risk off sentiment. That's typically what it signals to you as a trader and generally to the market. Let's go back to, and let's just drop that out the way. There we go. And we're back on the time base. If we move over onto the tick-based charts, the non-time-based charts, obviously a similar picture as you would expect, but this is where you see raw momentum revealed. Again, we're on the YM. I've got 3 time-based charts down here, which I've got the tick speed indicator running, which delivers the optimal tick setting for these guys over here, for these 3 charts. Because if you don't know what to set the tick chart to, what are you going to do? You're going to guess? You're going to ask a trader friend? I don't know. That's what happens. People don't know, traders don't know what to set these to because they have no clue. And the important point is this: these tick settings vary from index to index. If this was the ES, they'd be 4 or 5 times the numbers over here. This will be, the 1 minute would be running at maybe 3,000-4,000 ticks. The 3 minute would be running at maybe 10,000. The 5 minute would be running at maybe 20,000 ticks. That's how different they are. If you put gold on here, again, very different character. Think of any market as having a characteristics of that market. And that's why you need something like this to give you that optimal setting. It tells you what to set the charts to. The two numbers here are either the closest to the actual or the actual. And the reason we've done that is because, as you can see, the actual changes very, very quickly when you're running with both the Globex and cash markets running in parallel, which we've got now. They're both open. Volumes will be much higher. The rate of change of the tick activity will also be much higher. And that's the reason we developed this, so that to set the charts, it doesn't mean you have to change them quite so frequently. I've got this one at 377. This one at 987, which is coming off. In fact, it's just changed up to 1597. Let me just change this one up to 1597. So we've got all three. There we go. And this is just reflecting exactly the same as we're seeing on the time-based charts. But what we're seeing now is we're able to apply volume price analysis. If I flick this open, we've got a nice example here. Where you get these green areas, that means high activity. It means tick activity is high. It means big operators moving into the market because you're seeing an increase in the tick activity. You see it here. What happened? The market tried to rally, narrow spread candle, wick to the top side, high volume underneath it. What's that telling you as an intraday trader? Weakness ahead. It's not a positive sign. That's on a 1 minute. And obviously you're following through that onto the 2s and the 3s and the 5s. That's on the 3 minute. High activity under this candle, down spread, nice widespread down candle. Lots of selling under there, good volume. Nice to see. We're only going one way at the moment, one-way traffic. In terms of the indicators, exactly the same. I've got the VPOC on here, and I've also got the price-based support and resistance. And you're seeing these levels again. You've got one in here at 25,620. You can see it's just literally oscillating around that particular level. If it closes below it, then there's a good chance that's going to add some further downwards pressure. And if it does, and we get down to the 600 level and beyond, then we're into low volume in terms of this particular chart. But remember what I said earlier on the 30-minute chart, we've got some very strong resistance over on 30, or sorry, support over on the 30-minute chart in the 25, I think it was in the 580 area, so only 20 pips below that, 20 points rather. So you've always got to have in your mind not only what is going on your time frames and your multiple time frames, but in the slower time frames, maybe on a different workspace, or you have multiple monitors. In fact, someone asked last week what was the minimum number of monitors we would recommend. And generally, I would say 3 is probably about a minimum, and I'd say comfortably 4 to 6 is really the optimal. I'm sure you've seen them arranged on stands. I would say 6 is probably the best, and that's because you need to see all this stuff. We condense all this stuff down for you on the webinar, but that's what you need to see as a trader. You need to see all this stuff, the related markets, what's going on in the bond market. That's ticking up and down all the time on intraday basis. What's happening on the yen in terms of sentiment, what's happening with the dollar, etc., and also what's happening in terms of the related indices. If I just head over to this workspace, sorry, wrong one. That's this is just the 3 currency indices. You can see here, this is the yen on the 5 minute. It's rising strongly. That's what we want to see if we're short selling this at the moment. That's the dollar flip-flopping around, not really going anywhere at the moment. That's the euro on the right-hand side. Where I meant to go, apologies, was over onto this one, where we've basically got the 3 indices running together. Top line is the daily chart. They're all pretty much the same. It doesn't always equate that they will. On some days, we've seen the NQ up and we've seen the Dow down. It's unusual, but it happens. I think on those occasions, certainly the most recent example of that was with the tragic events of Boeing, and certainly that had a huge impact on the YM, on the Dow, but less so on the NQ, which actually closed up, whereas the Dow was down quite significantly. Down at the bottom here, you can see I've got these set up as 5 minutes. So I've got YM on the left, ES in the middle, and NQ over on the right. All pretty similar. What it gives you is a slightly different perspective in terms of volume and price action. Just helps to reinforce what you're doing on your time frame with what is going on in related markets, because generally speaking, they will tend to follow one another around. And you also get a slightly different perspective in terms of where the volume point of control may be sitting at any particular time on a particular index, and whether that is supporting, excuse me, bear with me a moment, and whether that's supporting your particular view and analysis of the market. So it's important, if you're trading indices, always have the associated indices up. When we were trading, we were always trading with the cash. We had the cash and the futures markets running together, because the cash market gives you insight into what is going on in terms of futures, both from a price perspective and also from a volume perspective. Just go back to the time-based charts again. Drop that out of the way. Still in congestion for the time being. Just have to wait and be patient. And just going to, this is the monthly chart for the YM. What's interesting about it is, as Anna said and highlighted in the introduction, that when you look at these things, you're not going to look at a chart like this every day, clearly, because it's not going to change that much. But they are important to consider, even from an intraday perspective, because maybe not the monthly, but certainly the weekly, and even more importantly, the daily. They just give you a sense of where the levels are, what is the market doing, and bear in mind, this is from, where are we? This is the end of last year. This is where we've been trading. So this period here is well over a year. And we are trading around the volume point of control. We have some decent price resistance above, and we've got volatility all over the place. We've had this volatility candle. That was at the start of the year, and we're still trading inside the spread of that candle. We haven't actually managed to break free. And the same was true on this one. Traded in there for an awful long time, peaked over the top here, and then rolled over, and then we got another phase of volatility. The markets rallied. We had pretty much a V-shaped rally back into that spread of that candle, and now we're trading still inside it. So the whole thing just gives you a perspective. And what's also interesting is when you look at the volume of these two candles. We had, attempt to rally. Okay, fine, that looks all right. Then we try and rally further, but the volume's falling away. So we're seeing a market that's trying to rally on falling volume. And the sort of similar thing you're seeing here, you're seeing decent volumes here, high volume here. It's come in, supported. We've had the shock, the shock reversal. The buyers come in, and then gradually they tail away. And as they tail away, the market's trying to rally. So it's giving you a sense of this market is not particularly strong. It's not being supported by rising volume, nor is this. It's no great surprise we got further congestion building on the monthly, and just giving you a heads up as to what is likely to happen longer term. Are you okay? Are there a load of questions you're answering? Okay, fine. And on days like this, when you're making money in one direction, you've always got to be light on your feet, because the momentum is just not in the market. Let's just, let me just move that out of the way. Sorry, I'm going to flick this back to the daily. There we go, back to the daily. And it just puts it into context. This is where we're trying to make money in here. This was the Friday's price action. Just pull that up full size. Really does put it into context. When you get days like this, and this, and this, and this, and this, those are the days you've got to make money. It's hard making money in here. So when you see these days developing, and you will see them, particularly if you're using non-time-based charts like the renko or the tick charts, of course you'll see it on the time-based charts. And when you wrap it around volume, and you use multiple time frame approaches, and you use the other indicators to help you with related markets, what's going on in the yen, what's going on in the bond market, etc., and you're using the indicators like the trend monitor or support and resistance, whatever it may be, the volume point of control, that will help you to get into those positions and get some money out of the market when it is moving, because they don't come along often, and when they do come along, you have to make money. What we've got at the moment here, we've got a real rally on 3. Let's just have a look at that one. We've got some rising volume, so there is some buying coming into the market. Is it strong enough? It's capped off at this level here. We had resistance at that level, and we've got much stronger resistance here. So it was no surprise to see it hit that level, and we'll see if it reverses off that and continues lower. No change in the trend monitor, as you can see, not a flicker yet. It hasn't registered the fact that potentially this is a reversal. It may do. Just going to switch off for a moment. Sorry, I just needed a mouthful of tea, sorry. Tea. Just see what's happening to the yen. Right, what's interesting, you can see on this is the fastest time frame I've got. This is on the 10-minute. You can see the yen there is starting to flatten. It's not continuing that angle of inclination here, which was very strong buying. For the time being, it's just flattened, and that is just a clue, a signal to expect the market to possibly congest, to lose some momentum. Now, if that picks up again and starts to climb again, then that's fine, we're okay. You know, the short positions should continue thereafter. That pause point, if you will, has not been reflected on 20 yet, and you wouldn't expect it on 30 because it's way too early. And all that is telling you is at the moment, for the time being, we are seeing yen buying. Just go and have a look at that on the chart. Just drop that out of the way. It's easier like that. Let's just have a look at it on the index itself, which is this one. There we go. Okay, there we are. Just pop that up full size. This is 5-minute, bear in mind. So this is pretty fast. And this is really what we're seeing at the moment, this congestion phase, which we're seeing on the CSI. And what we want to see as a bearish trader right now, intraday bearish trader, we want to see this climb through here and carry on higher. So that's the reason it's paused. The answers are always there somewhere. You just got to dig them out and find them. And if you weren't in this market right now and you're looking maybe for an entry, then the place to look, if you're on the fastest time frame, let's take the 3-minute. Let's just move that out of the way. Let's just suppose you've been waiting on the sidelines, you're not quite sure about this, you think it's bearish, but you're just looking to jump in. 25,600 looks like a decent level because it gets below this lot. Bear in mind that when you get to big numbers like that, anything 600, 650, 700, you often see congestion purely because that's where a lot of the orders are layered in. Because most traders are lazy, they'll lay them in around 5s and 0s, generally speaking, particularly big numbers like that. But if we clear that, then you know there's a bit of clear water. But remember what I said about this fella over here. There we go, that one, and that's 585, 588, something like that. So if the market does get down to that level, it'll be interesting to see what happens. If it goes through, fine, terrific, you know, off to the races. But if it doesn't, and the chances are it won't because it's so strong, expect congestion. So if you're sitting in a 3 or 4 or 5-minute trade and the market's moving sideways and you're not sure why, that's probably the reason, because there's some strong resistance or support somewhere on another slower time frame chart. Slower time frame support and resistance, indeed anything in terms of what trumps what, the slower the time frame, the greater that particular aspect, or the greater weight that particular aspect carries. So if you're seeing strong price resistance or price support on a slower time frame chart, that will trump anything on a faster time frame chart because it has the weight of time behind it. I hope that makes sense. Let's just check. Sorry? Did to Anna. Just to check out the renko. Let's pull that up. Renko is confirming the bearish situation at the moment. It's bright red, so that's fine. The trend dots work very close to the price action, so they will change more frequently. They'll change between the red and the blue. The trend monitor won't. The trend monitor takes a more considered view of price action, and is looking, as I say, it's got a longer horizon, if you will. Think of it in terms of horizon that it looks at. That's what it's looking for. Whereas the trend dots will change. They'll give you a heads up as to a potential change first. And if you see that reflected in the trend monitor, then that's the two indicators working together. But for the time being, we're not seeing that. It's just holding red for the time being. To say the key level is really down here now because we've got this platform in here, 25,600. That's really where we want to get to. What's interesting about the 30, you can see here we have this little rally. It's hit the volume point of control, so it's just oscillating in there, and we want to get down to this this fellow below. And the price action today is very typical of what you have to face as an index trader, indeed any trader. The market's a bit sluggish. Yes, there's money to be made. You've got to be reasonably light on your feet. You're not going to sit in these trades for long because there is very little in the way of market momentum driving this. It's too weak. So it's very much get in, get out. Let's go back to the tick speeds, which does reveal momentum. Whenever you get these red phases of price action, it means that the tick activity is dying away. It gives you an instant traffic light system on when you've got high activity in green, general average activity, if you like, in the orange, and when it moves into red, that is when activity is falling away. It means a lack of participation. The volumes are falling quickly, and traders are not involved. Big operators are not moving in. There's just a lack of participation. And that's when you're going to see markets moving sideways, because in sideways markets, there's very little participation. It's the long and short of it. Got some very strong support in here at 620. But then when we get down to 600, we're away. Low volume, still holding red on that. That's fine. See what the tick speeds are. Still running at reasonable speeds. We've got 377, 987 and 1597, so we're running along at that, but it'd be nice to see these ticking up to, and you can see it's all flashing slow at the moment. We've got slow, slow and slow all across the three time frames. This is a 1 minute, 3 minute and 5 minute, which is my preferred, but I know a lot of people use 1, 2 and 3. I prefer to push it out a little bit further than that to 5. Just gives a bit more breathing space. Let's go back to the time-based charts again. Just have to wait and be patient for the time being. If you're not in this trade, if you are in it, then it's a grind. That's half an hour. In fact, that's 40 minutes odd sitting in there. It's a bit of a grind to sit through that lot. As I'm sure many of you know, as Anna's told you before, I have a bias to downside, and the reason for that is quite simple, because markets generally fall much more quickly than they rise. Livermore was a heavy short trader as well, and it's probably the reason that a lot of traders do enjoy trading short, because once the market moves, boy oh boy, it does move quickly. You see it occasionally on a bullish trend if there's maybe some strong fundamental data or whatever it may be driving it, or maybe it's a risk move. But generally speaking, markets will fall a lot quicker than they ever rise. You can see this transition coming through now. See the dark red that's maybe just starting to creep in here, because this market's been in congestion. So the trend monitor is saying, okay, this we're not seeing this strong trend develop. We're seeing it congests. We've been here for a while. Now we've gone into dark red. That may go to dark blue. It may go through to blue if we went to bullish. It might go to dark blue and then revert back to red in due course. Obviously, if it goes to blue, then it's telling you it's a transition from a primary trend lower to a primary trend higher. And you're using the time frames in conjunction as well. You're looking for it over here, because what happens over here will ultimately happen over here if it is a change. If it isn't, what you're seeing down here is just merely a recognition of the fact that we are in a congestion phase on a fast time frame. Just going to switch off for a moment. Yeah, I can do. I think it's pretty much a doji, yep. Let's have a look. There we go. That's the big sized, oops, sorry, there we go, big sized chart. That's where we are. Trading in the slither of this lot, and you know, it's hard. We had the same day there. It was okay yesterday, the day before yesterday rather, and that was Monday, which was reversed. And we had the same yesterday. We had a sell-off and a reversal, which you see, and that is all reflected in terms of volume. When you see those reversals coming, you'll see it reflected in volume. You'll see it reflected across the time horizons. And if the market's been bearish, then you know, it's going to reverse into bullish. And it's one of those days where you have to be patient. You have to wait for those particular. It's very much a case of setting a level that you are comfortable with, and a point at which you think, okay, well, look, if it gets to that level, that's what I'm going to do. And if it closes below that level, I'm quite comfortable getting into whatever it may be, the short position or the long position. And you just have to wait and be patient. And once those levels are reached and cleared, then you jump in. And you might think, well, you know, I've given up. Just put this one up as an example. You know, if you're waiting down here, for example, for a breach of 600, and you think, well, I've given up maybe 30 or 40 points in here. You know, I've missed a 30 or 40 point move. But then the question you've got to ask yourself is, am I comfortable trading in here? Or am I more comfortable trading something like this once the move has actually developed? I don't want to be trading in congestion. I'm not comfortable with trading in congestion. So you just have to wait and be patient. To the upside, you might say, if you're looking at this as a long trade, you might say, well, actually, this level here, that's pretty strong. If we get through there, then, you know, I'm comfortable taking a position to the long side, bearing in mind I've got a lot of volume in here and I've got the volume point of control. So that particular move may not go very well. It hasn't got far to travel. If we got up to this sort of level, for example, then once we're through this level, then we've got very, you know, clear water ahead, light volume. This is, you know, a really nice place to take a position. That's all it's about. And you can't look back and say, well, you know, I've been sitting through the market grinding its way up here and I'm getting in up here, so am I getting in at the top? And the market's already moved 100 points. That may be true, it may not be true. The fact of the matter is, you know, you don't want to be trading in here. You don't want to be trading in here. You want to have some sort of comfort which is dictated by the chart, which is all about the resistance, support and resistance levels, which then give you that comfort of any reversal, having some sort of barrier to reverse into, should it reverse against you temporarily in the short term. And really, that's what it's all about. I'm going to pass back to Anna at that point.
All right, so just watching the pound yen, and the pound yen is even if you, as I said, you don't trade forex, it's a really good pair to pull up on a couple of time frames. A faster one, and as I said, I've got the 3 and the 30, but maybe have 3 minutes. I don't know, 10 minutes and then 30, and just watch the price action, because it does actually, you know, it does move, and you can, you know, you can learn an awful lot, both from a price action perspective, price VPA perspective, and if you have the indicators, it's a great way to sort of showcase the indicators as well, with the trend dots, the trend monitor. And in fact, what I've been looking at is here we've had a lot of volume come in, had some some very strong price support here at this level here, just over 144. 144.56. But going back to the 30-minute again, we are within this volatility candle here. It hasn't been able to move out of it. Now, in that 30-minute, in these 30-minute candles, then, as I said earlier, if you are trading the very fast time frames, there may have been some opportunities for you to take some trades, but that is the only decision that you can make. But going back to the 3-minute chart that we see here, this is the price support. The pivot then triggered the correction higher that we're seeing at the moment. There's buying coming in. If you didn't even have the volume under here, you've got the wicks to the bottom of these candles. Then you have this candle here. You've got a lot of volume underneath it. But you've got a wick to the top. There's a lot of volume, but there's some weakness coming in. What it actually tells you is that there's a struggle going on at the moment. The subsequent candles, this one you've got buying coming in. The next one is interesting because there's a real fall off of volume. So the pivot tells you that this is going to come back. Pivots are not there as potential entry signals or exit signals when they appear at the top of the candle, as we see here. They fulfill a number of functions. One of them is to point out that yes, on this case, the price is not going to fall any further. So that price is going to, and they only form on the completion of the third candle. It's based on a price action over 3 candles, not a single candle. That's the first thing. The second thing, the really important thing about pivots, is they actually highlight, and I've got some here at the moment, is a congestion. We developed them really to help us give some structure to the chart in terms of what kind of phase of price action are we looking at in a chart. Are we looking at a trend, or are we looking at a congestion period prior to the price moving out of congestion into a trend? And that's what the pivots do absolutely brilliantly. And we just wanted to, as I said, identify the phases of price action that we are looking at any given time on a chart. So what do we have here? That we've got some buying coming in, but it's all context. All price action has to be read in context of another time frame. As I said, I have the 30. I've got very clear levels here, which are telling me that need to be taken out if this is going in to the downside. And maybe it is, maybe it isn't. Let's have a look what's happened to the VPOT. The VPOT, no, it's pretty much where it is at the moment. But the buyers are strongly defending this level that we have here. In fact, this level is actually the low of all the 3 of the day, basically the 24-hour day. So I've got the 8-hour chart here. If I just put the data box on, I'll just show you here. When you hover over it, that says 21 hours. That is when that candle will close off. This is representing the 3 main phases of trading over the 24-hour session. So this will close off at 9 o'clock tonight, 9 o'clock our time. This actually closed off at 1 o'clock. This represents Europe and London, basically, and this one is Asia. But it's the 8-hour session, particularly if you trade 24-hour markets, are really, really useful. So we'll see what happens with the pound yen. But if you don't trade the pound yen, it's really it's a nice instrument. There's always something interesting on the charts in terms of volatility, great price moves, congestion periods, trends. It's just, isn't it, David? Don't you think so? It's just a very nice teaching chart for as I said, volume price analysis and also our indicators. What we have here is obviously the renko. The renko also has the line in the sand that needs to be taken out if this is going to go lower. Now, what's interesting here is this is the move lower that we're seeing with the pullback as well. The trend monitor has stayed relentlessly red. The trend dots have been red as well. We had a little cluster of blue ones here, but not enough to be able to confirm that that was actually going to move any higher. And in fact, it ran into that resistance that we have here. We're going to do a session on just support and resistance, and also looking at support and resistance, how to use them, as how we use support and resistance in volume price analysis, but also from the perspective of helping us with placing stop losses as well, because that is that's the reason why we should, the prime reason why we should use them, not just for entries and exits, but also for stop loss and trade management. Anything you want to add to that, David? No, that's it.
Do you want to flick back over here for a minute? Or not?
Have you got something? I think David's going to say something, and then we'll come back here and then we'll wrap up.
Just switching over onto Ninja, just only because we're now just, you're not seeing my screen, are you?
I can see it.
Oh, you can see my screen. Oh, brilliant. We're just starting to come. The only reason I wanted to flick back was because we're just starting to come back down and retest this key level, which I mentioned several times on the 30-minute. Let's just go back onto the 30-minute. There we go. This level here, if we get through 600, then it would be nice to see if what actually happens when it gets to this level. So I was just curious to see. It may not happen. We may be sitting here for a few minutes. We'll see. You can see the trend monitor here. We've gone to this extensive darker red. Nothing changed over on 5 minutes, and certainly nothing changed on 10. So in terms of keeping you in the position, that is what the trend monitor was developed to do. It was developed to help you manage the hardest aspect of trading, which is sitting in a position which has got some decent money in the bank, and then you see the position start to reverse gently against you and maybe picks up a bit of speed. That is when you start to panic, you close out, and you close out with a small profit, and you're pleased about that, which is fine. The problem is, if you do that constantly, you won't move forward, because I guarantee you will have more small losses than you have small profits. The key to this business is taking the small losses, but actually outweighing them with much, much bigger wins. And that's what these days come back to down here. This is where the big winners come out of. And all this other stuff in here, you might get some small profits. You'll certainly make some small losses trading in here. And that's what it's about. When the market's really starting to move, even with this move, you get a sense of momentum. In fact, if I flick over to the tick charts, you'll get a much better idea of it there. There we go. Let's flick over there. Now you'll see it start to, on a tick chart, because there is no time aspect, and the same applies to renko down here, you get a sense of momentum. You get that sense of speed of movement in the market. Is this market moving quickly? And it will start to pick up momentum, and you'll see that because there's no restriction of time. This chart, this 987 tick, the candle for when 987 ticks has gone through is irrespective of time. That could take a millisecond, nanosecond, half a second, full second, a handful of seconds, who knows. That's why you see momentum revealed on tick charts, and that's why index traders, intraday day traders use tick charts and also renko. Exactly the same principle with the renko. The difference is that, again, it's back to the optimal setting. What the renko optimizer does on Ninja is it delivers that optimal setting. I've got this set to 1 minute, and what it's telling me right now is I'm running at 13 on this particular index. So each of these bricks is worth 13 points, which is $65 by my maths. So, it's a pretty respectable return, even if you only manage to take a couple of bricks out. It's not a bad return. But that, again, it's down to the optimal setting for the chart. You can guess, you could say, well, I'm going to trade 5 points or 8 points, 7 points, whatever it is. but this is actually delivering this in real time. And when you change it up and down, if maybe in an hour or so's time we change this and click it again, it will have changed, because that's what the markets do. They're not constantly running at the same speed. It's not like running a car, driving a car with the automatic cruise control set. The markets are not like that. They speed up and slow down the whole time. You've got to be aware of that and trade with it. And part of that trading with it is picking up the correct settings for the charts at any one time. Same applies to tick speed. Same applies to the renko. Just starting to continue lower. You know, it's hard work, but the money's there. But you've got to sit through this stuff as well, and be prepared to sit through it on days like this, because it's not moving that quickly. You can see here we've gone back to orange, so we're trading in respectable tick activity. We're not trading in the red. We're still trading in the red down here on the 3-minute and also on the 5-minute, but it's starting to pick up here. And if this picks up and we get higher activity, then that'll be reflected through down into the other time frames as well. I'm going to pass back to Anna at that point and say cheery bye, and she's just going to wrap up.
To have lost one of my charts inadvertently. Anyway, very, very quickly. Thank you so much for coming along today. The indicators that we've used are our own, ones we've developed, and they're from Quantum Trading Limited, and you can find them at quantumtrading.com. As you can see here, we've got MT45, NinjaTrader, and also TradingView. And as I mentioned earlier, the next platform that we are developing is TradeStation. David and I, well, we used to have TradeStation accounts for Forex, but they stopped doing that because our account was based in the US. But I think they've got an international side now. I must admit, it is a great platform, and it shouldn't take us too long to port the indicators over, because they use a language called Easy Language, and it really is an easy language to code. As I said, if you want more information, it is over here. Below are all the individual indicators. If you just click on one, and it will take you to the page where you will find videos and all the support documentation for that particular indicator. The set of indicators that for Ninja that David was using was actually from our essentials package, and what it is, it's the packages that we offer. First of all, you can buy the indicators individually. You don't have to buy the full package. It doesn't matter. We've got bundled deals. Most people start with one indicator. If you're interested in a complete package, then what we offer is one for Forex traders, but we also offer a package called the Essentials package, and that is everything other than the specialized ones that we have developed for Forex trading. And the Essentials package comes in at $749, reduced down from 1,221. What you get if you invest in a full package is, whenever we develop new indicators, and we're doing that all the time, or we upgrade, they are all provided for free. So if you were to invest in the Essentials, you pay $749. That is it. When we develop new indicators, they're added to the package. When we upgrade, they're added to the package, and they're all covered by a 7-day money-back guarantee. And you also offer what we call the EPP, so you don't have to pay the whole lot up front. You can pay it over 3 months. The best place to look, as I said, is at quantumtrading.com. Lots of videos. You can find out more about the package as a whole, but you can just start with one indicator. And if you want any more information on the indicators or anything that we said here today, you can either drop me a line, anna@annacooling.com, or david@quantumtrading.com. Is there anything else you want to say, David? No, that's it. We're wrapping up for the day. Enjoy the rest of the trading week. It's certainly, it's certainly not going to be quiet over the next days and weeks. Well, not for us here in the UK, and we'll see what happens in the next quarter. We're back on Monday morning London time, where we look at just Forex on the MT4 and 5 platform. David uses Ninja. Oh, Tuesday. What did I say?
Monday.
Did I say Monday? No, Tuesday. Oh my goodness, no. Monday, my sofa's arriving on Monday, so I won't be able to do a webinar. We'll be here on Tuesday, and of course we'll be back next Thursday as well. So enjoy the rest of the trading day. Have a brilliant weekend, and we will catch you next time.